Hey everyone, and welcome to this explainer. Today, we're diving into one of the most dramatic economic collapses and subsequent recoveries an African nation has seen in an entire generation. Just 3 years ago, Ghana literally could not pay its bills. And today, well, it's making global financial headlines for the exact opposite reason. We're going to dig into the math, the policy, and the very real-world impact of this absolutely remarkable national turnaround.
Okay, let's jump right into this incredible contrast. Just think about it. How does a country go from a complete, formal financial default on its foreign loans in December 2022 to earning a sovereign credit upgrade with a positive outlook in just 3 short years? It's not an easy process. Actually, scratch that, it's an incredibly brutal process. So, to understand exactly how they pulled this off, here is our roadmap for today. First, we'll decode sovereign credit ratings. Then we'll revisit Ghana's 2022 economic collapse, break down the massive $3 billion IMF rescue, examine the painful path to recovery, and finally wrap up with a wider global lesson.
All right, let's kick things off with Section 1, Decoding Sovereign Credit Ratings. What exactly are these ratings, and why do they have so much power over a nation's financial fate?
Well, think of Fitch Ratings along with Moody's and S&P, kind of like a bank that grades your credit score before handing out a mortgage, but on a massive macroeconomic scale. The grade they assign tells international investors exactly how risky it is to lend their money to a specific country. The higher the grade, the safer the bet, which crucially means it's much cheaper for that country to borrow money. When you map out global financial risk, you've got your AAA or AA countries sitting at the top. These are your safest borrowers, places like the US, Germany, and Australia. In the middle, the BBB range features solid investment-grade countries like India, Brazil, and Indonesia. And then you hit the speculative category, bluntly known in the financial world as junk. This is where high risk equals punishingly high interest rates. Ghana previously sat at B-, which is just 3 tiny steps above a country on the verge of default. So bumping up to a solid B rating means the global market finally believes Ghana is steering the ship in the right direction.
Moving right along to Section 2, Ghana's 2022 economic collapse. Because to truly appreciate the triumph of this upgrade, we really need to look at rock bottom.
54%. Just let that sink in for a second. By 2022, Ghana's economy was practically in freefall, and inflation had hit this staggering, paralyzing peak of 54%. To really put that abstract percentage into an everyday perspective, imagine going to the store. Prices were rising so aggressively that whatever cost you 100 cedis in January would cost you 154 cedis by February. That is just devastating for an ordinary citizen trying to buy groceries or basic necessities. The local currency was just evaporating in their pockets. Let's trace exactly how this domino effect played out. Early in the year, inflation absolutely spikes. By mid-2022, the local currency, the Cedi, loses more than half of its value against the US dollar. Things got so severely out of hand that by late 2022, the government was literally borrowing new money simply to pay the interest on the old money it had already borrowed. And the final breaking point, December 2022, when Ghana had to formally suspend payments on its international bonds. They defaulted.
Which brings us to Section 3, the $3 billion IMF rescue. At a total breaking point, the country desperately needed outside help. Basically completely out of options, Ghana went to the International Monetary Fund. And the IMF ended up throwing them a lifeline, approving a massive $3 billion emergency program engineered to stabilize the bleeding economy.
But here's the catch. That money absolutely did not come for free. It came with the IMF's famously strict conditions. Step 1, cut spending. Step 2, raise revenue. And Step 3, restructure that massive debt. Ghana had to execute all 3 of these just to survive.
That leads us straight into Section 4. The painful path to recovery. You see, executing those IMF mandates wasn't some seamless accounting trick. It was a harsh reality for the entire nation. When you hear a phrase like restructure the debt, it honestly sounds like some harmless, sterile financial term. But in practice, it meant domestic bondholders had to take a massive haircut. Pension funds, local banks, and everyday ordinary savers absorbed massive financial losses on their investments. Essentially, everyday citizens paid the price to balance the national books. But the domestic sacrifices were only half the battle. Ghana's leadership also had to negotiate outward. By October 2024, they successfully reached a final agreement with their international creditors to restructure approximately $13 billion in foreign debt. And here's the thing, those brutal trade-offs, they actually produced undeniable, measurable results. Inflation was slashed by more than half,
falling from that terrifying 54% all the way down to around 23% by early 2025. On top of that, the government managed to run a surplus before debt payments. That exact track record of ironclad fiscal discipline is exactly what justified Fitch's credit upgrade.
Finally, let's zoom out a bit for Section 5, a wider global lesson. What happened in Ghana is actually a highly relevant blueprint that the rest of the world is watching closely. Over the past 5 years or so, we've seen nations like Zambia, Ethiopia, Sri Lanka, and Pakistan face their own versions of this exact same nightmare. They've dealt with crushing debt loads and collapsing currencies. Yet for most of these nations, recovery is still totally stalled. Now, Ghana isn't completely out of the woods yet, for sure, but they are leaps and bounds ahead of expectations. And really, the overarching takeaway of this whole explainer isn't about sheer luck or some sudden spike in global oil prices. As observers have noted, the real difference was a government that accepted a highly unpopular, incredibly painful restructuring program and actually stuck to it. No shortcuts.
So I'm going to leave you with this final thought to chew on. As we watch other struggling global economies try to claw their way out of junk status, the blueprint is right there. But the real question is, are there leaders willing to make the same hard, deeply unpopular choices that Ghana did? Thanks for joining me on this explainer, and I hope it gave you a much clearer view into how global debt and recovery actually work.